Imagine a treasure chest with $1 billion inside, buried for over a decade. Then one day, with no warning, it moves. This isn't a pirate story, it's the reality of Bitcoin. We're about to journey into the world of Satoshi's whales, the earliest adopters who hold fortunes that can shake the entire crypto market. We'll expose their secret identities and strategies, and by the time we're done, you'll understand the hidden forces that truly shape the price of Bitcoin. These aren't your average investors. They are ghosts of the blockchain, digital phantoms who got their hands on a fortune when Bitcoin was worth pennies and then just vanished. For years, their wallets, stuffed with hundreds of thousands of Bitcoin, sat dormant like sleeping dragons on mountains of digital gold. But now they're waking up, and every time one of them even twitches, the entire world holds its breath. So, what are they planning? Are they cashing out? Or is something much more strategic at play? The mainstream media loves to scream market crash with every move, but the truth is almost always stranger than fiction. The real story isn't just about the money, it's about ideology, security, and a long term vision for Bitcoin that frantic day to day traders have completely missed. We're going to follow the breadcrumbs on the blockchain, decode the cryptic messages in their transactions, and reveal the untold secrets of Satoshi's whales. To understand the whales, we have to go back. Way back to the beginning, the year's 2009, the global financial system is in chaos, and in some obscure corner of the internet, a new idea is born. A 9-page white paper published by the mysterious Satoshi Nakamoto introduces Bitcoin, a peer-to-peer electronic cash system. At the time, almost nobody cared. It was a project for a handful of cryptographers and computer science hobbyists. Mining Bitcoin in these early days was ridiculously easy. You could do it on a standard home computer. The reward for mining one block was 50 BTC, and the value of that BTC basically zero. It was a digital experiment. This is where the first whales were born. The folks who ran the Bitcoin software on their laptops, either out of curiosity or because they believed in its anti-establishment ideals, were stacking huge amounts of it. People were mining thousands of Bitcoin, sometimes by accident. On forums like Bitcoin Talk, users would just give away thousands of BTC to get others to try out the new system. The most famous transaction of this era, of course, was Laszlo Hanyecz paying 10,000 Bitcoin for 2 pizzas. At today's prices, that's $1 billion meal. The most mysterious of all these early miners is Satoshi Nakamoto. Before vanishing in 2011, Satoshi is believed to have mined around 1 million Bitcoin, a fortune that at Bitcoin's peak would make them one of the richest people on the planet. And yet, for over a decade, not a single one of those coins has ever moved. This massive sleeping treasure is the ultimate symbol of a Satoshi-era whale, immense, silent, and powerful. But Satoshi wasn't alone. Other early miners and adopters gathered staggering amounts. Imagine firing up a program on your computer in 2010, forgetting about it, and waking up 15 years later to find you're sitting on a fortune worth hundreds of millions of dollars. That's the origin story of the Satoshi whale. They aren't hedge funds or corporations, they're the original pioneers. For years, these wallets were completely inactive. Some analysts estimate millions of Bitcoin haven't been touched in over a decade. For the longest time, the market treated this locked up supply as if it were lost forever, digital shipwrecks at the bottom of the blockchain's ocean. But that assumption is being challenged. In recent years, and especially through 2024 and 2025, these wallets have started to stir. With each awakening, a wave of panic and speculation washes over the crypto world. The ghosts of the past are returning, and we're just now starting to figure out why. The beauty and the terror of the Bitcoin blockchain is its transparency. Every single transaction is on a public ledger for anyone to see. So when a wallet that's been sleeping for 14 years suddenly moves $1 billion worth of Bitcoin, the world sees it happen in real time. This is where our investigation begins, where we become digital detectives piecing together clues from the blockchain. Let's look at the kind of dramatic cases that have sent shockwaves through the market. These aren't just numbers on a screen. Each one tells a story. For instance, we've seen wallets dormant since the days Bitcoin traded for pocket change suddenly come to life, transferring billions of dollars. An initial investment of practically nothing can morph into a staggering fortune. The immediate reaction is usually predictable. The whales are dumping. The price is going to crash. But then something strange doesn't happen. The price of Bitcoin barely moves. There's no big sell-off. So why not? Because where the funds go is just as important as where they come from. Blockchain analysts are quick to point out when Bitcoin isn't moved to exchanges like Binance or Coinbase, which would signal a plan to sell. Instead, the funds are often moved to new, clean addresses. This isn't a market dump, it's a strategic repositioning. This pattern has repeated itself again and again. Take a common technique known as peeling or chaining. A whale holding, say, a few hundred Bitcoin might break it into smaller, equal batches and send them to multiple new wallets. It's a sophisticated move to manage large holdings without signaling a massive sale, not a sign of panic. Then there are even more direct transfers. We've seen cases where a massive old school whale moves tens of thousands of Bitcoin not to an exchange, but in a way that suggests a direct over the counter or OTC deal. In an over the counter deal, a huge seller and a huge buyer, usually an institution, transact directly away from public exchanges. This lets them trade enormous volumes without crashing the price. The whale gets their cash, the institution gets its Bitcoin, and the market is spared the drama. These moves show strategic thinking that goes way beyond the simple hodl or sell mentality. The whale isn't just cashing out, they're conducting a major financial transaction. What these events show is that a dormant wallet waking up is rarely the end of the world. The knee-jerk assumption of a market dump is almost always wrong. We are not watching reckless sailors abandoning ship. We are watching grandmasters move pieces on a global chessboard. To understand their game, we have to look beyond the transactions and into their minds. What are their secret strategies? After analyzing years of on-chain data, a clearer picture starts to form. Satoshi Whales aren't all the same. They're a diverse group with different goals and ideologies. The great untold secret is that there isn't just one secret. There are several distinct strategies at play. Understanding them is the key to understanding Bitcoin's hidden power structures. Let's break down the four main types of Satoshi Whales. Strategy 1, the strategic upgrader, fortifying the fortress. The first and maybe most common reason a dormant whale moves their coins has nothing to do with selling. It's all about security. This is the strategic upgrader. Bitcoin technology has changed a lot since 2010. The original Bitcoin addresses, known as legacy or P2PKH addresses, start with the number 1. They are now considered old school. They're less efficient, have higher transaction fees, and lack the advanced features of modern address formats. Bitcoin has had major upgrades, introducing new address types like SegWit, starting with BC1Q, and the latest Taproot upgrade, starting with BC1P. These offer lower fees, better privacy, and stronger security, including better protection against future threats like quantum computing. Many recent whale movements are just this: digital housekeeping on a massive scale. When you see a wallet from 2011 move billions of dollars from an old one address to a new BC1P Taproot address, you're probably watching a strategic upgrader. They aren't selling. They're moving their treasure from an old wooden chest to a state-of-the-art titanium vault. This isn't a sign of weak hands. It's a sign of deep, long-term conviction. Strategy 2, the cypherpunk idealist, the true believer. The second type truly embodies the original spirit of Bitcoin. This is the cypherpunk idealist. This person wasn't mining for profit. They were part of a revolution. They saw Bitcoin not as a get-rich-quick scheme, but as a tool for financial freedom, a way to opt out of a corrupt inflationary system. For the cypherpunk idealist, holding Bitcoin is a political statement. Selling it for fiat currency would be betraying their principles. These are the holders who watched their tiny investments balloon into unimaginable fortunes, but still refuse to sell. Their dormancy isn't neglect, it's discipline. Satoshi Nakamoto's own million untouched coins are the ultimate example of this ideal. When these whales do move their coins, it's often not to cash out, but to secure them for the future, maybe by placing them into complex trusts to be passed down for generations. This could be seen as a generational transfer of wealth, where an original holder's fortune is moved, not necessarily sold, but managed as a legacy. These idealists are the bedrock of Bitcoin's value. Their unwavering choice to hold through every bubble and crash creates a level of scarcity and a price floor that the modern, flighty market often doesn't get. They are the silent guardians of the network. We're about to dive into the most controversial whale strategies, including the ones that can actually move markets. This is the kind of deep dive analysis you won't find anywhere else. If you're enjoying this journey into crypto's hidden history, take a second to hit that subscribe button and turn on notifications. You won't want to miss what's coming next. Strategy 3, the market shaper, the grandmaster's move. Now we enter the shadows. While many whales are passive holders, some are far more active. This is the market shaper. These players know their huge holdings give them the power to influence market sentiment, and sometimes the price itself. Their actions are deliberate, strategic, and often misunderstood. It's a common myth that these whales just pump and dump. That might happen with tiny unknown coins, but the Bitcoin market today is far too big and liquid. A single whale trying to crash the price would be like trying to redirect a river with a small dam. The institutional money on the other side is just too powerful. Instead, market shapers are more subtle. Their main weapon is psychology. They know a large transfer to an exchange can trigger panic selling from smaller investors, even if the whale doesn't sell right away. This creates liquidity and volatility they can use to their advantage. For example, a whale might move 10,000 BTC to an exchange, causing the price to dip from fear. They can then use that dip to buy more Bitcoin at a discount through other, less obvious wallets. They create the storm, then they sail right through it. On chain data from recent years does show a split. Older Satoshi era whales seem to be consolidating for the long term, while newer whales, likely institutions that bought in at higher prices, are quicker to take profits. The original whales are playing chess, while the new money is playing poker. Strategy 4: the lost fortunes, the digital graveyards. The final type is the most tragic and adds the most to Bitcoin's scarcity. These are the lost fortunes. Not every dormant wallet belongs to a disciplined holder. Many belong to people who have lost their private keys forever. In the early days, securing Bitcoin was a mess. People stored their keys on unencrypted text files, old hard drives, or scribbled notes. Stories are everywhere of early miners who threw away laptops that would now be worth hundreds of millions of dollars. One of the most famous examples is James Howells, a British IT worker who in 2013 accidentally threw away a hard drive with 8,000 Bitcoin on it. He has spent years and millions trying to convince his local government to let him excavate the landfill where it's buried. That hard drive is a physical tomb for a lost fortune. Analysts estimate that somewhere between 2 to 4 million Bitcoin may be permanently lost. These coins are effectively removed from circulation, locked in a digital graveyard. This permanent loss is a powerful, often overlooked bullish force for Bitcoin's price. It makes every remaining Bitcoin that much scarcer. So, after following the digital breadcrumbs and profiling these different whales, what's the ultimate secret? It's this. The biggest secret of Satoshi's whales is that their power comes not from selling, but from not selling. Their decade-long dormancy and strategic, security-focused moves show a profound, long-term belief in Bitcoin that is completely opposite to the frantic, short-term focus of today's crypto market. For over a decade, the market has obsessed over one question: when will the whales dump? But that was always the wrong question. The right question is, why have they held for so long? The answer is that these early adopters understood Bitcoin on a fundamental level. They understood its mathematical scarcity. They understood its resistance to censorship. They understood its potential as a global store of value in a world of endless money printing and unstable geopolitics. Their long-term holding is the strategy. Their dormancy is a vote of confidence in Bitcoin's end game. The very existence of these huge, unmoving piles of Bitcoin provides a psychological anchor for the entire market. And now, the awakening of these whales isn't the disaster many feared. It's actually a sign of a maturing ecosystem. The moves we see now, upgrading security, making professional OTC deals, and planning for generational wealth, are the actions of rational, long-term players. The market's ability to absorb these multi-billion-dollar movements without crashing is also a sign of its own strength. In the past, such a move could have caused a flash crash. Today, the market is deeper and more robust. The real story of Satoshi's whales is a story of conviction. It's a story of a generational shift where early, ideologically driven holders are now building the financial plumbing to preserve their wealth for decades. They aren't leaving the system. They are reinforcing their position inside it. So, what does this all mean for the future of Bitcoin? First, the scarcity is very real and likely even more extreme than the 21 million coin limit suggests. When you combine the idealists who won't sell with the lost fortunes that can't be recovered, the actual available supply of Bitcoin is much smaller than most people think. Second, the behavior of these whales provides a powerful counter narrative to Bitcoin being just a volatile fad. Their decade-plus holding periods are the ultimate proof of its use as a long-term store of value. As they move their assets into more sophisticated financial structures, they are paving the way for Bitcoin to be seen as a legitimate, multi-generational asset like gold or real estate. Finally, their actions force us all to be better analysts. We have to move past the simple, fear-based headlines and learn to read the blockchain for ourselves. We need to know the difference between a panicked sell-off and a strategic security upgrade, between a market dump and an OTC deal. The world of Satoshi's whales is one of silent power, long term vision, and strategic patience. They are the ghosts in the machine, the architects of Bitcoin's past and its future. They got their fortunes not through frantic trading, but through early conviction and an iron will to hold. They remind us that in the world of Bitcoin, the loudest voices are often the least informed, and the most powerful moves are made in silence. The next time you see a dormant wallet awaken, don't panic. Instead, watch closely. You might just be witnessing the next chapter of Bitcoin's hidden history being written.